Good morning. Welcome to another edition of A Matter of Interest, a MoneyFarm podcast. I'm Richard Flax.
And I'm Jack Amy.
This morning we'll touch on a few topics. We'll address the Middle East conflict, which seems to have re-escalated. We'll say a few words about earnings and valuations in equities. And we'll talk a little bit about the latest macro data from the US and comments from the Federal Open Market Committee minutes.
Great. So as you mentioned, we've seen a re-escalation in the Middle East, comprising of attacks on ships in the Strait. We've seen some attacks from the US on Iranian assets and retaliation on US or US allies' assets in the region. Ship traffic fell, so not to zero, but we saw, I think, 21 ships cross the Strait on Wednesday, down from 35 to 60, which is what we've been seeing in the last few weeks. However, the US have come out and they've said that the talks for a permanent deal are ongoing. Has it changed our view on that situation and its ramifications for financial markets?
So we're recording this, I should say, on Friday, July 10th, and a lot can happen in a short space of time, so worth highlighting that. I think our basic sense is that this doesn't change things that much. At the end of the day, our view has been that, without digging too much into the details of exactly how, that the two sides will find some sort of an off-ramp that will allow the Straits of Hormuz to reopen in a meaningful way in terms of the amount of oil passing through the straits. Clearly, the renewed tensions are not a great outcome, either for financial markets or for geopolitics, but for regional stability. But our base case, I think, remains the same, that the two sides will find a way to de-escalate the situation, perhaps not in a nice, neat, straight line, as we've already seen. And that should put a cap on where oil prices potentially can go. What is interesting, though, and we've been looking at this a little bit, is the gap between kind of oil prices and oil derivatives, things like gasoline, jet fuel, etc. And that gap has stayed pretty wide and has actually widened. So even though we think oil prices stabilize, perhaps not quite where they were at the end of February, but certainly lower than the recent peaks, we think it may take a little while longer for oil derivatives like gasoline to really begin to come down. And that obviously is a challenge for households globally. But also, I think, a challenge for central bankers who may see inflation continue to be impacted by the conflict that we've seen.
And it's maybe worth diving down on that particular point where gasoline in the US is one of the largest components of household spending. And we've seen prices that were at roughly $3.50 per gallon in the US jump well above that, but it's still at sort of $4.50 at the moment. And the heuristic is $1 on gas prices leads to about a percentage point jump in inflation. So this could potentially be quite painful for households, but also not particularly helpful for US GDP growth.
Yes, and we'll talk a little bit more about that when we address central bankers and the recent comments from the Federal Reserve.
Great. So switching topics now, we have been looking obviously at equities, as we always are. And we've seen something interesting, I think, on valuations in one particular market, and that is the KOSPI, so the Korean index of equities, is at its cheapest in one specific metric. It's cheapest since the financial crisis. So kind of looking into the future with analyst estimates, you can create a price earnings multiple. So the price of the stock divided by those expected earnings. And that ratio has hit its lowest since the financial crisis. Is that the buy signal that you might think it could be?
Yeah, so really interesting. Obviously, we've seen a lot of very strong earnings results over the last few months, particularly from the tech sector. The Korean market is dominated by some very large technology companies, notably Samsung Electronics and Hynix, producers of memory and semiconductors. And so they've benefited significantly. And so you've seen earnings expectations for the Korean market really jump dramatically, in the hundreds of percentages from last year. The 2026 earnings growth is now expected to be, in triple digits. And so what's interesting is that as you've seen that, the valuation of Korean equities has gone down. And it tells us a couple of things. Well, we think it does. Firstly, the Korean market is generally regarded as a very cyclical market. These are cyclical businesses. The playbook generally says that investors should not extrapolate current very strong earnings growth into the future. There is a cycle to these things, as there is in commodities, for instance. And so, we should be wary, or investors should be wary about looking at current earnings and just continuing to see strong growth from here, because history tells us that it moves around a lot. And what's interesting is from my perspective at least, is that, there's a lot of talk about AI optimism, AI boom, etc. But the valuation in the Korean market tells us that investors are following a similar playbook, right? They aren't extrapolating very strong growth into the future. They're assuming some sort of a normalization of earnings over the next few years. And that, we think, explains why the valuation of Korean stocks in aggregate is as low, at least at a headline forward PE, as the chart would suggest.
And it's worth, I would say, noting and to back you up there, that if you look at the last 12 months of earnings, these stocks don't look nearly as cheap as they do on the expected earnings. So there is an element where the market is pricing in a not too many years of such high earnings growth, as you say.
And so is it a buy signal? Well, look, I think it's really tough to say because, the sort of conventional wisdom is that you should actually buy cyclical businesses when their PE or their price earnings ratio is very high, i.e. when their earnings are very depressed, and you should be a little bit more wary of them when their PE is very low, because it probably means potentially means that they're at some sort of peak earnings. And so there you come back to the challenge of, okay, well, how sustainable is the AI boom? How long will it continue? And these are obviously, difficult questions to answer. The underlying momentum at the moment is very strong. Spending is very strong, and companies like these are clearly benefiting. But when we do think about, or we do discuss expectations and are expectations too high, I do think it's somewhat reassuring to see a market like Korea, which is now being priced very much as a cyclical market, rather than extrapolating some sort of secular growth as you might potentially do kind of elsewhere in the world. So actually I take it as reassuring, but perhaps not for the reasons that you might think at first glance.
And I think switching topics a tiny bit, but it is a very interesting market to look into in more depth, because you mentioned those two names of the Kospi, again, the sort of the headline index of Korea. They're over 50%. Those just two stocks are over 50% of the index. And there is a lot of trading activity in these stocks. So trading the underlying, so actually exchanging the shares of these companies, but also some more exotic financial products like leveraged ETFs, where an investor can get a multiple of the performance on the day of these equities. And you are beginning to see an impact in global equities, particularly tech-related equities, of the activity that's going on in Korea. So you've got big swings of momentum. Day to day, you're seeing up and down moves rather than a chain of positive moves. And as the market sentiment improves, for example, you're seeing kind of almost a reversion, suggesting that there are signs of almost a structural imbalance, and that these stocks have had such a run up that they're now kind of moving the equity market because of the amount of trading activity that's going on, maybe not just the underlying fundamentals and investors' view on the next 3, 6, 12, 24 months for these assets.
Yeah, there's a couple of other sort of relevant points here. One is that Hynix has recently listed, or is in the process of listing, an ADR in the United States, which is basically effectively a certificate that allows US investors to own a stake in Hynix while still staying in the US on US exchanges. And that is A, heavily oversubscribed, and B, has been very large. And so we think that will provide a new avenue for US retail investors potentially to express a view on this part of the tech supply chain. But I think it's also, I would say, a challenge for us from a portfolio construction perspective. You have a market that has grown very significantly, that has become increasingly volatile in its sort of day-to-day moves. And so you need to be mindful about how you size your exposure within a kind of a globally diversified portfolio. But when we put Korea in a global context, obviously there's the portfolio construction angle that we think a lot about. But the other part around it is what does it tell us about the tech supply chain? And there, it's very interesting because, you can ask yourself the question is, why is the valuation not higher? Why are you not expecting kind of stronger growth in the future? And the answer usually is because you expect some sort of a capital expenditure response, right? There's a lot of demand for memory. We've seen, as we've said in the past, Apple raising prices on some of its products because it needs to pass on some of that cost of additional memory chips. But that's not going to last forever. What we've seen in the past is that you do see a supply response. You see companies sink more capex, and obviously governments are taking an increasing interest in this and are looking to push some of these companies to increase their capital expenditure to build out new kind of plants and new equipment. And so there is a rationality to this valuation gap that we see where, we'd argue that the market or that investors are expecting a supply response in terms of increased capital spending, and it'll take a year or 18 months. But typically equity markets can look through that and say, yes, we expect to see much more supply coming on stream. Potentially that means lower prices. and then potentially lower margins for some of these segments going forward. And that's even before you consider the possibility that, market growth won't be quite as strong as the most optimistic estimates.
And I think that's a really interesting point, because we have been looking at the free cash flow, so the cash generated by what are classified as hyperscalers, so very large US tech companies. And for the last 10 plus years, these companies have been generating lots and lots of cash profits. But over the last couple of years, that's actually turned negative. So again, investors are potentially going to be asking the question, how sustainable is this spending boom on AI-related infrastructure, and how long can these companies continue to invest now that they are not generating cash and they're in fact spending this cash investing in this technology, which number one might suggest that the demand for a Samsung or an SK Hynix might not be perpetual into the future, but number two would suggest that these investments are going to throw off positive externalities like more supply of memory, of semiconductors.
Yeah, look, it's super interesting. And in some ways, we are now in a slightly different world where we spend more time talking about technology companies and the bond market than we ever did before. For years, we didn't really think about the bond market in the context of large tech names because they were, as you say, highly cash generative. Sometimes they raised debt to to have a more efficient capital structure to perhaps return some cash to shareholders.
But the market was very kind to them when they did.
And the market was very kind because it was relatively scarce. Now, as we've discussed in the past, you're beginning to see some very large, not just equity offerings, but some very large debt offerings as well. And so the fixed income market is paying, a lot more attention, or is seeing a lot more supply, but then paying a lot more attention to tech companies. And so by extension, we will be looking at the fixed income markets, corporate credit market for some of these companies to understand what signals we are potentially getting there. And you can be, it's a joke, but maybe with some truth to it, right? The equity market, obviously, where the upside is unlimited, has a tendency towards optimism, right? Fixed income investors, kind of by definition, are a bit grumpier about the world, and they're more concerned about getting their money back and the risk that they're not going to do that because their upside, as the name suggests, is somewhat capped. And so understanding how fixed income investors are thinking about these issuances is kind of important, because it'll give us a steer as to what the appetite is from a part of the market that, as you said, with all the free cash flow in the past, you didn't have to worry about quite as much.
And then as an investor, how do you think about the challenge of getting over the fact that in the equity market, there's a lot of concentration in tech and AI-related names, but that concentration is now beginning to seep into the bond market. And obviously, MoneyFarm portfolios hold equities, they hold government bonds, but they also hold corporate bonds. How do you think about the concentration risk that you might end up getting, where not only is the equity portion of your portfolio heavily tilted towards AI, if you're invested in the US, for example, but it's also a larger and larger part of your corporate bond holdings?
Yeah, this correlation question is really interesting. I think on the equity side, so let's start there. On the equity side, as you say, the concentration, particularly in the US market, has risen over time. It's not as concentrated as some other markets, as you mentioned, Korea. But the US equity market is still 65% of global equities by market cap. And so if that market shows higher concentration, it has much more of an impact than if a relatively smaller market sees similar concentration. And I would say, so that market's become more concentrated. Technology has become a bigger and bigger piece of emerging markets, of the emerging market universe. And so potentially you see this world where, years ago you might have said, well, emerging markets in the US are within the equity space, are kind of diversifiers up to a point, at least they have different drivers. Now, potentially, you're saying, well, actually, no, the drivers are in many ways quite similar. It's this global tech supply chain that stretches from, Taiwan and Korea through the US, through the Netherlands in one instance. And so that has implications from a portfolio construction perspective. So you're looking either at the geographic level. For instance, the UK is, for better or for worse, less exposed to kind of global tech than some other markets. You can look at it in a factor context. Perhaps you look for some kind of lower volatility indices that potentially have less tech exposure. But even as we've seen in for instance, in value, right? The value index has a lot more tech in it. It's slightly different tech, but a lot more tech in it than you might have expected. And so has actually benefited from the technology, from the rise in technology stocks that we've seen over the last couple of years. But to your point around fixed income, it's very interesting because, again, the fixed income exposure, for instance, in data centers was a bit more focused on private credit.
Yes.
Which we don't currently have exposure to. We only have, it's not private markets we haven't yet launched in. And so we felt kind of a bit more comfortable about that. Actually, obviously, a lot of questions about the economics of data centers and, who was really carrying the risk. And so we were somehow reassured that we didn't actually have that exposure. As you say, as we see some increased issuance from tech names. And look, they're large issuances, but in the context of the kind of global credit market, it's not yet that big, but it's definitely something we'll need to keep an eye on. And then think about, the kind of geographic exposure or the types of credit instruments that we buy, potentially to mitigate some of that risk.
Brilliant. Thank you. That was very, very interesting.
Before we continue, a quick note about MoneyFarm. We're a digital wealth manager with a simple purpose: to combine passion, expertise, and technology to give clients the 3 building blocks of investment success: access, advice, and low cost. Today, we help people manage their wealth through investment portfolios, pensions, ISAs, cash savings, and self-directed investing, all accessible through our platform and app. Whether you prefer to make your own investment decisions or receive expert guidance, our services are designed to support you at every stage of your financial journey. Alongside our team of investment experts, clients can also access Bastion, our AI-powered agent, which provides personalized insights and clear, accessible guidance to help them make more confident financial decisions. As always, remember that investing involves risk. The value of investments can fall as well as rise, and you may get back less than you invest. The views expressed in this podcast should not be taken as advice. Now, back to the conversation.
So switching on to the third topic, so a quick, again, look at US macroeconomics and what's going on in the US economy. We sort of touched on it earlier, but we had the FOMC meetings, so the minutes from the Federal Reserve, the US Central Bank's committee that decide on interest rates. And we also had some jobs data. So what's your view as to what's happening in the US economy right now?
Again, it somehow goes back in some ways to the point around tech and around AI, right? Which is a kind of a sectoral theme or an equity theme, but actually the numbers are so big that they are impacting the kind of macro environment as well, right? They're a meaningful
contributing, right, for maybe a drop in consumption, so a drop in the activity of everyday consumers in the US is being made up for by the investment in AI.
So I think that's right. And I think, it has obviously broader macro implications, because if you sort of think it through and you have the thought experiment and you say, well, okay, what happens if AI spending slows, right? Does that have a macro implication? I mean, the answer today, I think everyone would say was yes. You would expect to see the global economy or the US economy begin to slow as a result. Potentially, that means that there is a positive effect for inflation, right? That it might actually be deflationary, particularly given all of the demands around construction materials and energy and things like this that are necessary to build out those data centers and to build out that kind of data infrastructure.
And I think that's a really crucial point to make clear here, that we speak a lot about AI-related investments, we speak a lot around semiconductors, but to actually build a data center touches the quote-unquote real economy in several places. You need power, you need water, you need a big building, it needs to be cooled. So there are lots of other sectors that are pulled into it, right? A lot of job creation, a lot of economic activity that's maybe not just captured in a few single names who produce semiconductors.
Yeah, and I think that's very important because, it has implications across the board. Obviously, we're talking now about the macro side, but as you say, when you think about the amount that's being spent, technology was deemed to be asset light, right? You didn't have that many buildings, you didn't have that much stuff. It was, kind of, in the cloud, as it were. And now that has shifted fundamentally. Right, it shifted over time as you began to build out more of these data centers for the likes of Amazon Web Services, right, which is a really big driver of Amazon's growth and performance, but also for a range of other companies. The investment profile and, as you said, the free cash flow profile of these businesses has changed fundamentally. Now, clearly, these management teams are looking for a return, right? They're hoping that they make these investments today, and they generate the profits kind of in the future, and financial markets have been happy to, for now at least, to fund that. But it is something that will continue to be a focus of attention. Anyway, coming back to the question around US macro, it is clearly being positively impacted in terms of growth by all the AI investment. But when we look at the labor market data, it was a really interesting picture, because actually versus what analysts were expecting, job creation wasn't quite as strong as people expected. The unemployment rate actually was lower than analysts had forecast. And wage growth was pretty robust, but was in line with expectations. And so the question is, well, what should we make of all of that? I think on the unemployment side, the usual answer to how do you have lower unemployment and lower job creation is that labor force participation fell, that there were fewer people actively measured as being in the labor market. We think that there's some component of this that's around immigration, right? And there's obviously been a change of policy in the US over the last couple of years. And we think that one of the reasons why job creation has potentially been lower is that the sort of labor supply of the supply of workers perhaps hasn't been as quite as strong as it was. And that has allowed kind of in some ways the unemployment rate potentially to come down. But one of the things that it means, we think, for central bankers is that the kind of job creation numbers that you see don't need to be as high as they were in the past to digest all of that kind of labor supply. And so when you think about the labor market as a potential source of inflation, you could be in a world where you have lower job creation, but it doesn't necessarily mean lower inflation because labor supply hasn't been quite as robust. And that's something that kind of we think central bankers and also investors will need to somehow recalibrate if this is right as an idea and if it persists, because you may see where previously 150,000 new jobs in a month was kind of a inflation neutral. Maybe that number is now going to be 50 or 75,000. Yes. And that has implications for how we interpret that kind of labor market data and also how central bankers do it.
And on that point, we had the FOMC meeting minutes come out last week. What was your take on that? They were maybe mildly hawkish, but there was a general consensus that the entire committee agreed not to hike rates. But given all of the topics that we've just discussed and the difficulties that the US economy is facing, or more accurately, the difficulties monetary policy setters are having to manage inflation, growth and employment in the US, with obviously the sort of the fiscal side in there as well. What did you make of the minutes and what challenges are the Fed facing?
Yeah, so just by way of background, the Federal Reserve central bankers in the US, they released their kind of conclusions. In this case, they said that they weren't going to hike the policy rate and that all of them agreed to that. And then a little while later, you actually get the minutes of that meeting that gives you a little bit more insight about, the discussions. And it's a way for central bankers to kind of provide a bit more granularity, give you some sense of what the mood was within the committee, what the debate really was. And what we sort of took away from it was that it was, yes, they left rates unchanged, but on the margin that there was a cohort of policymakers who perhaps did consider raising rates in the face of higher than kind of targeted inflation. But in the end, they all sort of collectively decided that they would leave it where it was. But clearly the debate was about whether they should keep rates where they were or hike them rather than keep rates where they were or cut them. And that is, was, I think, probably expected. But again, is also a just a bit more granularity and a bit more insight into how these policymakers are thinking about it. And, I think that the other part that was said was that some policymakers said they thought that the current policy regime was restrictive and some thought was that it was basically neutral. And that was kind of interesting to me a little bit as well. So nobody thought it was particularly loose, even though you've obviously seen some very strong numbers from things like equity markets or, kind of areas that might benefit from a lot of kind of liquidity in the markets. But the other message was that there were a number of policymakers who didn't think it was too restrictive, who didn't think that these rates are very high. They thought it was consistent with where their long-term goals of bringing inflation down kind of should be. And so that was interesting to me. And I think they face a meaningful challenge. And the challenge is inflation is somewhere around 4%. Now, some of this, as you kind of mentioned before, is a function of higher oil prices or higher gasoline prices for now an extended period of time, several months. But we can also say that the labor market looks pretty healthy. Wage growth is sitting there at kind of 3.5% still, having admittedly come down. And the message from a number of these central bankers is, look, policy is kind of neutral. It's not super tight. It's not super loose. And so I think that is sort of teeing us all up for a scenario where if you see inflation persist at these relatively higher levels than target, remember the central bank is looking for inflation around 2%, unemployment remains pretty low. And, particularly I think if you see inflation broaden out, not just to be a function of energy, but also to be a function of kind of services and perhaps stickier types of inflation in the services sector, that is laying the groundwork for potentially rate cuts later in the year. But then the last point around this from a longer term perspective is obviously we lived through a period in the post-financial crisis times when inflation was really quite low. And it does feel to me at least that since 2022 in particular, we're in a slightly new inflation regime where inflation is a little bit stickier. And so the potential there is that even if you see kind of inflation begin to to fall, the potential for central bankers to cut rates aggressively, absent a kind of a recession, is a bit more constrained.
We're probably not going back to zero interest rate policy anytime soon.
And that, by the way, would be a good outcome. Zero interest rates are not an environment, a particularly healthy environment. But it means we do need to think about the possibility that inflation could potentially reaccelerate faster than maybe was the case in the sort of 2010 to 2020 period. And that has implications from a portfolio construction perspective. So what sort of instruments are we going to buy? And we, probably leads us a little bit more to inflation-linked instruments, makes us a little bit warier of long-duration government bonds without that inflation.
Which suffer, to put out, in an environment where if central banks are forced to hike rates aggressively to counter inflation, the longer duration part of your portfolio is going to suffer.
Yes. And so we are looking, we have an exposure obviously to inflation-linked bonds, and we think that maybe there's potential there to add to that exposure. But again, it's a challenging environment for central bankers. I guess it's always a challenging environment for central bankers, but they're still coming from a place where the labor market side, particularly in the US, looks to be in pretty good shape, and inflation is a little bit higher than they would like. And so we think, potentially this tees them up to hike rates as we head towards the end of the year.
And it's worth noting, roughly 1/4 point, so 1/4 percentage point hike is priced in more or less by the market. So that's what the market's expecting.
But it also does come back to this question, how do you think about AI? How do you think about the spending around artificial intelligence? Because we think that this is the numbers, as we said, are big enough and persistent enough for this to have an impact on the broader global economy and the broader macro environment, not just in the US, but kind of elsewhere. And so as that persists, yes, that is that supports growth. But if we were to see, for whatever reason, some downturn in that, then, that would feed not just into obviously the tech space and into equities, but into the global macro environment.
Yes.
Great. Well, that's all we've got time for today. Thank you very much for listening, and we look forward to speaking to you again soon.
Please remember that when investing, your capital is at risk. The views expressed here should not be taken as a recommendation, advice, or forecast. If you are unsure investing is the right choice for you, please seek financial advice.